Welcome to today's Dealmaker event on the economic forecast for 2024. I'm Dan Primack, business editor at Axios, coming to you from Boston. Big welcome to our audiences on Facebook, YouTube, LinkedIn, X, and of course, Axios.com. And if you are following along on X, please use @Axios and the hashtag Axios events. So this is the final installment of our 2023 Dealmakers series. So we want to look at what's coming ahead for the next 12 months in terms of deal activity, sectors, and all that. And our first guest is co-head of M&A for the Americas at Goldman Sachs, Brian Hofrecht.
Hey, Dan, how are you? Good to see you.
I'm doing well. So we are less than 2 weeks now from Christmas when all bankers and private equity executives and everybody else go on vacation for a bit. And it feels like we almost got our quasi first merger Monday in a while. We had a big oil deal with Crown Rock. We had Macy's getting an offer to be taken over. We even had Cigna and Humana saying they weren't doing a deal, which seemed notable in its own right. Like, here's a decision, not just a rumor sitting in the papers. My question for you is there a particular reason why we seem to be seeing a little bit more big deal activity, or is this just the typical year-end push before vacation?
I think bankers are just so excited to have a lot of deal activity going on. I'm not sure there's going to be a lot of people putting in for time between Christmas and New Year's. So I think people are excited to be back. But overall, I would just say, we've gotten to a much, much better place in the current environment. I think as we watch the macro continuously improve throughout the year, we've just gotten an environment that's much more conducive to M&A. And I think when you look at 23 as a whole year, I think it would be a shame if people looked at this through the lens of a full year. If you look at where we are in the environment, the year is going to probably end up with about $3 trillion of total M&A activity, which is going to be about down 20%, which is going to look like a ho-hum, unimpressive year. But I think if you look at this over the course of the last 18 months on a monthly basis, you can actually see why it's an exciting environment and there's a lot of positive momentum. If you back all the way up to, call it, spring of last year, at the beginning of the rate hiking cycle, we saw a not unexpected pullback in M&A activity as people adjusted to the new macro data, to the financing environment. And as that permeated all the way through the beginning of this year, we started out in a really dark place in January. I mean, it was literally no activity, similar to what we saw.
Can I ask about that? So when you talk about the macro and how the macro has improved, thus kind of the almost tale of 2 years, when we say macro, are we really only talking rates? Because GDP has been fairly good throughout the year. The jobs market has been fairly good throughout the year. Stock market obviously had some bumps, but is it really rates and rates alone that is kind of either driving or depressing activity?
Well, it's important to remember there's a lag effect with M&A. And so when you stop the deal-making market and activity goes away, it becomes, it takes a bit of time for things to pick back up. So I would say that it's not just simply rates. I would say the macro is important. But if you back up to last year, the reason why rates went up is because of the macro. We had very difficult inflation at the beginning of this year. We really started 23 assuming we were going to have a hard landing. The strength of the U.S., though, has been exceptionally impressive. And so I think what really changed things in the spring, the macro data started getting a little bit better. GDP continued to grow. Employment data was good, but not too good. And so I think that really helped. And then I think people really adjusted to valuations, the new deal-making environment. By the time we got to the spring of this year, things really picked up in a positive way, but not to a normalized level. I think things really stabilized starting in March of this year all the way into Q4. And it was really Q4 where we saw the return of mega M&A. We saw improved market breadth. And at that point, by the time we got really to October, we were at a level that was, commensurate with activity that we've seen over the last 10 years or so.
I'm curious, when you think, and obviously every deal is different, but in general, a lot of the stuff that you're either working on now or about to be working on now, how much of that is brand new? In other words, stuff that wasn't being contemplated a couple months ago, as opposed to processes that were at least considered maybe last year, maybe at the beginning of this year, but folks either held off because of some of the macro you talked about, or maybe even started and then pulled back?
Yeah, good question, Dan. I think it's really a mix of both. I think we had a lot of processes that were just put on hold. And the nice thing is, deals that made sense 6 months, 12 months ago, can make sense today. And I think clients remain focused on their most important strategic priorities. And so when the environment became conducive, when financing markets picked up, when things were a little bit more stable, we've had a reinvigoration of a lot of those historical processes. But I would say there's a lot of new things going on. There's a lot of new themes, a lot of new things that are exciting, whether it's energy transition, AI, tech, everything. And so we're not just immediately picking up what we put down, 12 or 18 months ago. So I think it's a nice positive mix. But I would say that certain sectors led the way, and certain sectors really even didn't slow down. So when the market reopened, no big surprise, natural resources, industrials led the way. Folks that had better balance sheets, more stable cash flow outlooks, things that were a little bit, sectors that were easier to do deals in at that point in the market. At this point right now, though, we're seeing much more improved breadth in the market.
Is there a sector that has been relatively depressed in 23 that you expect is going to have a significant rebound in 24 from an M&A perspective?
Yeah, no, I think they're definitely. And so I think the sectors and themes that have been working throughout the entire year, I think we still feel very good about. But the most beaten up areas and the engines that we think are going to really rev a lot harder heading into 24, tech as a big one, the return of sponsors, another big one. And then as we look to, geographically, it's really more the rest of the world and cross-border. And so if you look at 23, what led the way? Old economy led the way. Stock deals led the way. U.S. led the way. As we look to next year, some of those engines that were, firing a little bit, a little less active through the year, those are starting to pick up. We're starting to see it in the numbers a little bit, things that you guys can see in terms of reported deals, but we're seeing it even, much more in terms of dialogue, with management and at the board level.
When you're talking cross borders there, and I assume, and tell me I'm wrong here, given what you do, that you're primarily talking about U.S. targets. Geographically, is there anywhere in particular you're seeing more inbound interest coming from than somewhere else?
Maybe a little bit more towards the Europe side. And so Europe and Asia have been a lot slower. Hopefully that will pick up. We're starting to see, a little bit more activity within the regions picking up, which hopefully will lead to activity that's either inbound or outbound with the U.S.
Brian, let me ask, one of the things that seems to be putting a bit of a chill, or has put a bit of a chill on U.S. M&A over the last year, particularly on the strategic side, has been antitrust regulators, whether that be the FTC or the DOJ. Do you believe they've had, under Biden, they've had a much kind of more expansive view of what antitrust means than under past administrations? Do you believe that has had a significant chilling effect, and do you see any reason for that to change going forward, at least through the next election?
Hard to tell. I think people are adjusting to the new normal with a lot more regulatory focus on deals. What I would say is it's certainly gotten a lot of attention, and there've been a lot of high-profile deals. When we look at the overall market, I think it's important to remember, this is a market that does $3 to $6 trillion of M&A per year. Tens of thousands of transactions, most of which have very little impact from regulatory review. And so a lot of that normal course activity continues to carry on. I think people are being thoughtful about the regulatory outlook and potential risk in deals a lot more so than they had done before. I would not say that it's causing deal activity to slow down tremendously, but it has added some uncertainty because a lot of these novel theories that are, the FTC and DOJ are contemplating, it's a little bit harder to assess in the boardroom. I would say more than anything, people are being very thoughtful earlier on in the deal making process, assessing the regulatory risk of any particular deal and making sure that protections within the documents, reflect the risk of any given deal, depending on which side you happen to be on.
The FTC will argue, maybe they even say this publicly, but folks around the FTC will argue, look, it's not about how many of these cases, the public cases, we win or lose. It's really more about kind of the ones we kind of kill in the crib because there's a fear of us coming in. Do you agree with them? Have there been a significant number of potential high-profile mergers that have really never gotten off the ground because the decision was made, it was too risky, more so than would have been in the past?
There probably are some. I wouldn't say that it's, again, it probably affects a very limited number of transactions, but I think people are really thinking about that and being a bit more thoughtful, and certainly recognizing that if you push a deal that may, be a little bit more, have a little higher risk profile, you have to be prepared to litigate. And so I think that's, the new reality, the new norm, and probably a handful of deals per quarter, that may have been contemplated historically may just, sit and, not get done at this point in time.
Brian, we have just a few seconds. So final question, you talk about kind of how this year was bifurcated a bit. When you think of 24, does it get bifurcated too with activity slowing down when we get around the November election, or is that not an inflection point in terms of deal volume?
We are going to focus on the election as a potential impact area, but when we look at the historical data, election years do tend to be down years, but they tend to be more pronounced. That pullback tends to be more pronounced in Q1 and Q2 as people try to take a view on where things are headed. That said, the overall momentum in the market right now may overshadow any typical pullback given the base that we're coming from. And so it's a little bit uncertain at this point in time, but if there is an impact, we likely see it out of the gates in Q1, Q2, more normalized as we get to the back half.
Brian, thank you very much for joining us.
Great. Thanks for having me, Dan.
And now a view from the top segment with my Axios colleague, Fabrizio Drummond.
Thank you, Dan. I'm Fabrizio Drummond, Axios Chief Business Officer. Thank you, Cooley, for making this conversation possible. Up next, we're going to hear from Div Gupta, partner at Cooley. Div, welcome to Axios.
Thank you, Fabrizio. It's great to be here, and I'm looking forward to our discussion.
Thank you for joining us. Well, let's kick off talking about the capital markets. It was a bumpy year for capital markets in 2023. Can you kind of walk us through the factors that impacted the market this year and whether or not we should expect the market to pick up steam in 24? And what are the contingencies that will influence whether or not we're going to see a resurgence?
It's a great question, Fabrizio, and I'm sure everyone's looking forward to 2024 after what has been a bit of a rocky 2023 with a lot of external global events, etc. That being said, 2023 did see a bit of a thawing of the capital markets, not nearly the levels of capital markets activity that we saw in 2020 and 2021. That being said, there seems to be a lot to be more positive about going into 2024. Certainly, if we look at the first 9 months of 2023, there was approximately $403 billion of equity capital markets activity during the first 9 months of 2023, which represented an 8% increase compared to the first 9 months of 2022, and the strongest opening for the global equity capital markets activity in 2 years. Total proceeds for IPOs on U.S. exchanges was about $17.8 billion during the first 9 months of 2023, more than double a year ago levels and a 2-year high. And global secondary offering activity totaled $240.1 billion during the first 9 months of 2023, representing a 16% increase compared to a year ago, and also the strongest opening period for capital markets, for capital raising since 2021. So it's a lot to be bullish about from that perspective. In terms of IPOs, they were led by the healthcare, tech, and consumer industries. The profiles of these companies seem to be varied, but the bar to going public seemed to be quite high. In some cases, there was a need for stability and profitability, particularly in the non-healthcare sectors. And in the healthcare sector and life sciences, there was a significant demand for IPOs in the I&I, that's the inflammation and immunology sector. We saw 3 IPOs that raised a significant amount of proceeds in the I&I sector, including, I believe it was over $600 million raised by Accelerin, $250 million raised by Abivax, and over $300 million raised by Apogee Therapeutics. There was significant interest in that sector, and we can dive into kind of why that was a little bit further as well. The one trend that we saw most significantly, which I believe will continue into 2024, is that there needs to be strong insider investor support for those IPOs that want to go in 2024. That we saw that in 2023, and I believe that will continue to be a trend in 2024, Fabrizio.
And Dave, let's zoom into life sciences and healthcare in terms of how it performed compared to the broader market. We definitely saw in the second half of this year increase in the IPO activity. Walk us through your thoughts in terms of what is what are the factors behind this push for biotech financing? And is this something that we should expect to continue to see in 2024?
Yeah, so Fabrizio, I'm hearing from a number of sources, including companies that are looking to go public, bankers that are looking to take companies public, that in 2024 we should continue to see more of a thawing of the capital markets. I certainly don't expect it to be at the same level as 2021, maybe not even as 2020, but there are positive signs that I believe will continue to foster equity capital markets and IPO transactions, including the fact that the Fed seems to be backing off of raising interest rates. And I believe there's somewhat of a feeling that perhaps we'll start to see a reduction in interest rates, cutting of interest rates into the first half of 2024. I believe that should spur investors coming back to the markets and possibly investing in IPOs, which will mean that companies will try to go public in 2024 as well. One of the other things that I would remark about healthcare and life science companies, in 2023, they tended to be later stage biotechs with promising clinical trials and strong product candidates, as opposed to companies that are preclinical or in the phase 1 stage. Again, many of those companies were in the I&I space. We might continue to see investor interest in that space, particularly because there have been many companies in 2023 that were actually acquired by big pharma for over $1 billion in the I&I space. And I believe investors are placing bets that there are going to be more acquisitions by big pharma in that space into 2024. There were not only those 3 companies that I mentioned that went public via the traditional IPO route in the I&I space, but we also saw several companies go public via reverse mergers and de-SPACs in 2023 in that same space, which should result in probably more companies in that space going public in 2024.
Excellent. Well, let's now switch gears to more of the regulatory landscape. The SEC has been very active this year in rulemakings, with the expectation that in 2024 we should see more of it, including the climate change disclosure rules. What is the impact that rulemaking has in the capital markets, and more specifically healthcare and life sciences?
Sure, Fabrizio, it's a great question. We saw SEC rulemaking final rules relating to cybersecurity disclosures, clawback policies, and 10b5-1 trading plans this year. Next year, we're likely to see final rules on climate change and possibly on SPACs and de-SPAC transactions, as well as proposed rules relating to human capital management and corporate board diversity. The ultimate result of all of this rulemaking is likely to be just an increased cost for companies to go public and be public, because they need to be adding either internal resources or paying external resources like law firms to help them manage and comply with all of these new SEC rules.
Excellent. We're about to get the hook here, Dave. So our closing thought, what is the one piece of advice that you would give businesses and companies considering an IPO in 2024?
It's a great question, and this is what I would tell companies that are looking to go public. Take a good look at the resources that you have, both internally and externally at the company. Really make sure that you have the appropriate resources, whether it's your internal management team to be able to tell that equity story for your IPO transaction, and also execute that IPO transaction, whether it's on the internal resources on the accounting and IR side, but then looking at your external advisors along all of those lines as well, both on the accounting, legal, investor relations side to make sure that you execute that transaction well, but then also that you are ready to operate as a public company going forward.
Excellent, Dave. We'll leave it at there. Thank you so much for joining us.
Absolutely. It was my pleasure and great to have this conversation. Happy holidays and Happy New Year.
Thank you to you as well. And thank you, Cooley, for making this conversation possible. Now over to our next segment with my colleague, Kia Kokalicheva.
Thanks, Fabricio. And our final guest today is Managing Director and Global Head of Life Sciences for General Atlantic, Brett Zabar. Brett, thank you so much for being with us today.
Thanks for the opportunity to chat with you. Appreciate it.
So one of the things that I learned while I was prepping for a conversation was that you guys have been investing in healthcare, but life sciences is an area that became a core area only in 2020. So I'd really love to hear, what is it that you guys saw in the market at the time that made you double down? And how has that changed since then? Because obviously the market and the world is a little bit of a different place now.
Yeah, it's all of that is true. And GA has actually been a long-time investor in life sciences for upwards of 20 years. But as you said, we stood up life sciences in 2020 as one of our core growth equity sectors. And really the idea was an indication of our commitment to the space and our conviction in the long-term opportunity. As you probably know, General Atlantic is a very thematically driven investor. We spend a lot of time thinking about secular megatrends, and we certainly see the innovation in life sciences driving significant growth over the next 20 years plus. So when we identify an opportunity like that, it's our usual MO is to make a substantial investment in time and resources. And that really is a big factor in us standing up the sector.
And so what has changed since then? Because obviously a lot of things have happened, macro trends. Has anything changed in the way you guys are approaching life sciences investment?
So our overall focus has remained the same in terms of companies that are developing and commercializing significant innovations that are creating value and benefiting patients. And that really spans broadly across the life sciences sector, covering therapeutics, as well as life science tools and services. Within that, we have a significant focus on really all aspects of precision medicine. On the therapeutic side, that encompasses areas where we have a very exquisite understanding of the biology, and we're taking more chemistry and engineering and execution type risk. And then in terms of tools and services, those are really all of the companies, tools and services that are supporting and enabling the development of those medicines. Now, there's no question, as you point out, since we stood up the sector, the environment has changed dramatically, the financing environment. Of course, the IPO market is shut down. We've seen significant changes in valuations on the public side, and we're beginning to see turns in valuation on the private side. Fortunately, during the earlier period of time, we were disciplined. General Atlantic has always had a very significant focus on fundamentals. There are many situations that we saw valuations that, from our perspective, were not supported by fundamentals. And now we're at a place where we think this new investment regime that we're in benefits long-term investors like General Atlantic that are really looking to work alongside companies to grow value over time. We spend a lot of time working with management teams on value creation plans. And in terms of the IPO market, fortunately, we're in a position where we're not particularly focused on when companies can access the IPO market. If it makes sense for a company in a given situation to stay private for a period of time, we are prepared to do that. So from our perspective, the new investment regime actually has created many more opportunities than when we first stood up the sector in 2020.
Did you have any portfolio companies that have had to make changes in their plans? Maybe they wanted to go public, or maybe they wanted to do some transactions, and now they've had to rework the plans.
Certainly, we have a number of companies that have spent a significant amount of time thinking about how to, for example, prioritize their pipelines and extend runway in order to ensure that they have capital required to reach significant value inflections. But what we've also seen, especially in the public market where valuations over the last period of time have been so depressed, are opportunities for transformative M&A and asset acquisition. So we've had a number of companies that are spending a significant amount of time looking to strengthen their pipelines with assets that, from our perspective, are undervalued. The other interesting change that we're seeing is actually on the large pharma side. A good number of companies, large companies that are reprioritizing their pipelines and undergoing strategic shifts are actually exiting therapeutic areas wholesale. And in those circumstances, we're seeing assets or even business units that are seeking outside capital. And in those circumstances, we often see assets that are more attractive than we would when those larger companies are making one-off decisions to divest assets.
Speaking of pharma, GLP-1 drugs, people know them as Ozempic and all of those. Such a hot topic, lots of activity even in the market. I know you mentioned earlier that you're not invested in that area, but something that you're watching. What are you seeing in the market, and how do you expect that to play out in the near future?
In terms of GLP-1 drugs in particular?
Yeah.
So obviously, there's been a huge amount of activity and significant commercial success in this space. And I would just emphasize, I mean, the way we're thinking about it as a team, it is still quite early days. And what that means is, from our perspective, there's still room for innovation in terms of oral options coming on the market and combination options that will enter the market over time. And we think those will have an opportunity to displace the current market leaders. And also, of course, we'll see the introduction over time of generic options. And even though it'll take some time for us to get there, we do expect this will be an area of significant focus for payers. So overall, we expect this to continue to be a very large market opportunity. But within that large market opportunity, we would expect significant share change over time as new entrants come online.
Do you think that companies who are in weight management or any of these adjacent areas are going to have to all come up with, you know, their pharma strategy, their Ozempic strategy, or something like that?
You know, we certainly have seen a lot of buzz around that level of change. But the reality is, our view, at least, it's still, again, very early days in terms of how long patients will stay on therapy, what the implications of long-term therapy will be. So, you know, it's probably too early to write off the snack industry. But, you know, we do think there will be significant changes, again, within the biopharma space as companies figure out how they want to participate.
Obviously, this can't be a deal-making conversation 2023 without talking about the acronym of the year, AI. Would love to hear your thoughts on how you think AI is going to reshape healthcare and life sciences in the near future. Like, how are we actually going to see that change life sciences and healthcare?
Yeah, as you would expect, it's a topic we spend a lot of time on. It's a topic that we spend a lot of time discussing with one of our senior advisors, Mathai Mammon, who was previously the global head of research and development at Johnson & Johnson. And this was an area he was quite involved with there. And, you know, we've basically developed a framework looking at the ways that we expect AI and machine learning to impact drug discovery and development across the value chain, ranging from target discovery and validation to hit identification and lead optimization, all the way through to clinical trial conduct and ultimately commercialization. And our point of view is that the impact of AI and machine learning is going to vary dramatically depending on where in that framework you're really focused. I would say on the drug discovery side, we, at least on our side, have not yet seen the definitive proof point that machine learning deployed in the area can develop chemical matter that is yielding an improved benefit for patients that we would be able to achieve with a number of very skilled medicinal chemists in a reasonable period of time. Certainly, I think there are opportunities for acceleration, but we haven't yet seen the definitive proof point that, for example, we're able to use machine learning to develop chemical matter against a difficult to drug protein. I do think it is a matter of time as we get better at developing and leveraging large data sets that will help us apply these advanced analytics. But for us, you know, we are in a little bit of a watch and wait mode until we get there. In the meantime, we are spending time in the areas where we do think AI and machine learning can have a more near-term impact, for example, in various aspects of clinical trial conduct and commercialization.
Well, that's interesting that you're still a little bit cautious around drug discovery with AI, because that seems to be such an exciting area. What does excite you when it comes to life sciences and healthcare right now, investing wise?
So I actually think that 2024 is going to be an incredibly attractive year to deploy new capital. I mean, we've seen a lot of behaviors over the past few years that distorted the market, including private market valuations that weren't supported by fundamentals. And we're starting to see more companies either grow towards their valuation or finding more opportunities to find an intersection on value with new investors. And that kind of investment regime is well suited to long-term investors that, as I mentioned earlier, are inclined to sit down with management teams and develop meaningful value creation plans. And fortunately, we've been able to surround ourselves with exceptional talent to develop and execute on these plans, including, for example, our emerging strategic relationship with Thermo Fisher. And this is something that began earlier this year when we brought on board another one of our senior advisors, Mark Stevenson, who's the former EVP and Chief Operating Officer of Thermo Fisher. So we're seeing, again, in this new investment regime, opportunities across therapeutics, tools and services, and also certain areas within contract pharma services that we think will be great areas to deploy new capital.
Well, sounds like we're going to have to check back in a year and see how much you've done in 2024. Thank you so much for being here with us, Brett.
Thanks very much for having me.
Thank you all for joining this afternoon for another Axios Dealmakers event that has made everyone smarter faster. For more on deals and deal making, or to sign up for the Axios Pro Rata newsletter, visit axios.com/newsletters or go to the Axios app. Thank you all for joining, and we'll see you on axios.com.